Hello and welcome to another episode of the Swing Trader Weekly Status Update. It's Justin Nielsen, your host, and it is October 8th, 2024. Another wonderful Tuesday. And joining me back from his vacation is Mike Webster, our senior market strategist and one of the big brains behind Swing Trader. So how was your vacation, Mike?
Oh, it's always nice to you just take a break. And so went to see Marcus King, and something that everyone should do. It's a rite of passage. You should do it as often as possible.
There you go. Okay, so let's take a look at some of the stuff that we've got going on, and it's probably worth starting out with the Spider S&P 500 SPY. A lot of times where we like to start, and I guess first things first, is this another setup?
Well, it looks like it, and it looked like it 2 days ago, and it looked like it 4 days before that. And but this is what I would typically call a setup day, meaning you've got a tiny spread on the chart, and that could be on an index level or a stock level. Is just a terminology I use, where you've got a small spread closing pretty much at the highs for the day, and that's what we had today. And you're in position where it's either at a trend line, either a downtrend line, or here that's more horizontal, that your expectation is for it to break out above that. Now that's what it looked like yesterday or 2 days ago, and it looked like it there where you were starting that line, and then it came in. So you're kind of at the mercy of the news, but this is what things should look like before they launch and break over an area of resistance. And so that's what I'm looking for happening tomorrow, but we will see. We'll keep an open mind.
Yeah, and to be fair, there have been a number of these times that have looked like setups in the past. Did a change date to June 18th, which looked pretty good. That kind of tight action, as you were saying, right up at the highs for the close, and then this ended up, we'll just go forward here. This ended up pulling back to the 21-day moving average line, getting support, coming back up. We had this July 16th day, another kind of setup right here that you were noting. And then that ended up kind of reversing and not looking so great. So, and then there was also, just fast forwarding to the September 23rd, to take a look there. Another day that you pointed out. So there've been a few like kind of false starts here.
A lot of them.
Yeah, a lot of them.
And that's what's been,
yeah, I was being kind, right?
yeah. It's very
what do you make of these? I mean, when you kind of get that setup, and it, we've talked about a lot of expectation breakers this year. So is this, how do you prepare for that? When you've been getting a lot of expectation breakers, do you still go for it when it sets up?
Yeah, it's kind of that thing where you don't really change your stance,
Right.
and that whole philosophy that, like Bill O'Neill, the founder of IBD, would talk about is, unless it's, you know, materially broken, where it just doesn't work anymore, versus then you have to adjust. But with this, as far as the setup days, I mean, setup days have been working that way since 1880, forward. It's just we've been in this weird time, really last, I don't know, 6 months or so, that is had lots of whipsaws, lots of movements underneath the surface, where the indexes will look fine, but you've got tons of rotation that is just really tricky for swing trading, unless you get a little luck on your side. And so I'm looking at this and I'm going, okay, my expectation for tomorrow is for us to break out and go higher, because that's what I know from.
Oh, did he freeze for you?
Can you? Hello?
Yep. Okay, I can hear you now.
Can you hear me? Okay, I'm
Yep.
not going to touch anything because my PC's been temperamental
Very
today.
glitchy today. Yeah.
Yeah. So, anyways, what I was saying was, you don't change things, because I'm not sure where I cut out, but basically, our expectation, or my expectation, is for us to move up above this area tomorrow, really, because that's how we're set up. But we're at the mercy of what news is going to happen overnight. We're in a very news driven time frame, especially between now and the election. Really,
Hmm.
we've got the Fed, which we're going to talk about. We've got the hurricanes. Lots of constant news flow. But if you just look at the index level, it's acting normally. Where I call this a shelf. We've just been going sideways here, hanging in tight, and that's ideal action. It's just been frankly frustrating because you get these breakouts that come back in just enough to shake you out before they move higher. So it is what it
Uh-oh.
is.
Well, now we heard that. So
That was not on purpose.
right.
So
Well, let's turn our attention over to RSP, which is the S&P 500 equal weighted. What are your thoughts here, Mike?
yeah. So, well, I think we're gonna have to keep this short because my PC is giving me trouble all day. But it's acting normally. We removed it from the list just because we were, just raising some cash. But there's no, when we remove something, you shouldn't feel like compelled unless it's breaking down to sell it yourself if you have room in your account. But lots of times we're just we want to buy something else that's faster, or the market's coming in and we're looking for, where we want to reduce, or, lots of times it'll be based on our cost basis if we just want to cut the losses very quickly. But it looks fine as well. It's getting support there at the 21 day. And so that's the way I like to look at the breadth, is looking at the RSP or the QQEW, which is another good one. But the RSP has really been better this year. But right now, this is set up
Yeah.
nicely as well, and
Hmm.
that looks really good. But you can see how it
But to your
looked
point, it
just
was
like
also
this
set
two
up two
days
days
ago.
ago.
Exactly. And if you go back to when it was breaking out over that cup with handle, even though that wasn't a setup day, that was a big gap up there, and you wouldn't have expected the next day to come in. And so you've had a lot of these little major expectation breakers like we had on August 1st, and a lot of minor ones that we've had, constantly, like we had yesterday.
Hmm.
So it's just what we're doing is trying to spread out. And you ran some stats for us with some ATR work. I don't know if you have that for us to show this week, but basically we're trying to spread out with things that are relatively slow moving, as well as some heat in
Hmm.
there, because it seems like the market is rotating back and forth between kind of your slower, pokier New York stock exchange type of stocks versus some of your heat, your Nasdaq heat. And so we wanted to have a balance between, all of those. So we've got, the Nvidias of the world, which I think we both have positions in,
Yeah, I do
on
too.
the
Mhm.
list, as well as some slow names that, like a Tyler, that is really tight and slow. I'm not sure if it's gonna work out, but that's on the other end of the spectrum of, it's a really tight action, and it looks like it wants to go up and, break through 600. So we gave that a shot today. We'll see. If it takes out today's low, we'll probably back away from that pretty quickly. But so we're trying to balance things out amongst groups, as well as with the from an ATR level as well.
Yeah. So to your point, and maybe I'll do a pie graph or a histogram on this for future episodes. But we have two stocks that are below 2% for the ATR, and this is pulling it from Market Surge, which uses a 30-day ATR. ATR, of course, stands for average true range, which basically says, okay, how much does this typically move from the high to the low? And it does take into consideration, that true range takes into consideration gap ups and gap downs. So rather than taking the low of the day, it'll take the close of the previous day for those situations. So that's the average true range. And as I said, we got two that are below 2% for the 30-day ATR. We've got, let's see, two that are between 2 and 2.5. We've got three that are between 2.5 and 3. We've got two that are between 3 and 3.5, and then we've got 3 between 3.5 and 4, and then Nvidia is our highest at over 4, which again, Nvidia has been a little bit more wild lately,
Mhm.
but 4% is, I've seen worse. Let's
Oh,
say.
yeah. I mean, there are stocks that we were looking at, earlier today, Chris had brought up Hood, that we
Mhm.
were thinking about, and that one that's an over 5%, ATR. And so we had just were getting it a little bit too late, so we couldn't put it on the list because with a 5% ATR, the likelihood of getting um kicked out of that when we like to cut things at 3 to 4%. There's names we just got to either pass up on, or unless we get it exactly right, like the day before,
Mhm.
that we just can't play. And the Palantirs of the world and those stocks that are heat, we can't play with this particular product. Doesn't mean you can't trade those at home, but it's just you got to know what product you're looking at.
And actually, on the 30-day, Hood is actually only 3.74%.
Wow.
Palantir, I'm surprised, is down at 3.36. That might not have included today's action. That might be using yesterday's. I'll have to take a look at that in market search. But yeah, we did talk about that on IBD Live. I was thinking I was going to buy it today, but by the time IBD Live finished, it was out of there.
Yeah.
I think when I was looking at it on IBD Live, it was up 5% for the day, and by the time IBD Live was done, it was up 7.5%, 8% for the day, and then it was up, I think, over 11% for the day at one point. So, but yeah, not a bad setup. So yeah, we've definitely spread out into some higher heat names, but we also are balancing it out with, as you said, the Tyler technologies that are a little bit slow moving. And I mean, we were even talking about Costco, looking like it was potentially set up. And this, of course, is a slower mover as well, but that getting support at the 50-day moving average line. So you mentioned headlines kind of at the start.
Mhm.
And I wanted to just kind of circle back to that because there have been a lot of market moving type headlines. So, I mean, let's start with China stimulus. I mean, we saw China just go crazy as this stimulus came out, and then of course today, it was it was really ugly looking. I mean, I think what was the Hang Seng was down 9% or something like that. The index, and a lot of the Chinese stocks got hit. We didn't put any Chinese stocks on. Why was that?
Well, in hindsight, we could have put Baba on, and we were looking at Baba closely, before that news hit, and when it was in the cup with him, when it was in the handle area. And I've just historically had a negative bias towards China just because, I've been in a few that, well, I was in one NQ years ago. I don't remember
Mhm.
what year it was, probably a decade ago. There was a Chinese stock, and it fell like a rock. Like,
Was that the
man,
Muddy Waters
the
report that
muddy,
came out?
yeah, not the good muddy waters, but the
Right.
bad, the other. We like
Yeah.
the
A
that
big
muddy
short
water.
selling report came out on it, right?
Yeah, and I think it was up at the time when I put my order in, just up 1% or something, and it wasn't acting right, and then the news hit, and that I got out by the time I got filled, I think it was down like 50% or something like that. I could
Yeah.
have it off a little bit because I tried to block that out of my memory, but I swore off China stocks for a while after that one, and I saw a lot of ones like that would blow up. Let's pull up the PDD that got hit recently, and
And
so
this actually made me a little uncomfortable that PDD being one of the,
quality
leaders,
ones.
was hit so hard on its last earnings report.
Yeah, so it just brings a different level of risk. But let's go back to the Baba because this is more of a quality one, and we played this back in the day when it was the model book move as well as Baidu. Those were great stocks. And so in hindsight, we should have put this on, but it gapped up on that on the day that it gapped up above the handle. Um, I was hemming and hawing on it, and I just let it go because of that negative bias towards China. Now
Mhm.
you've had this news out there that we'll see how it plays out. I know things got hit today, but typically when these switches happen, the, the trend should be up. Notwithstanding the hit that everything had today, and so we might play them, but we'll just play them probably with like a K web if that sets back up, probably or FXI or an ETF that we feel comfortable with. We're not going to play this now, but we're going to wait and let it tighten up a bit. But we wouldn't do much there just because I think you have that added risk. Plus,
Right.
with it being an election year, depending on which way that goes, that does. The reality is, we're not a political show, but you want to be aware of the risk that's involved with something. And China ahead of an election, material election, it brings on a added risk. So we'd probably just do one stock if we did it.
Let's call it rotational risk, right?
Exactly.
And again, it's dependent on who wins. You could very easily see some sectors, some entire sectors, be very different looking depending on who wins the election. And the reality is that changes. I
Mhm.
remember in 2016, after Trump's initial victory, even before the inauguration, a lot of infrastructure plays, were really doing well, and some of those things that it took a while for them to actually get done, and so they kind of subsided. So even the initial reaction might not be what ends up happening long term, but the market does kind of say, okay, now the odds have changed on this thing, so you do have to be aware of that. A few other headlines just to kind of go through.
Sure. And
We were talking about.
just on that point,
Mhm.
before we move on, I just want to say to really keep an open mind, and don't think to yourself, okay, if she wins, these are the groups that are going to work. If he wins, these are the groups, because there's so many other things that are going on. Is there a mandate in Congress? Is it split?
That's huge, huge.
That's yeah. We don't know how that's going to play out, and so just have an open mind and let the charts tell you what's really working. And that's a tricky thing to do because we all have our biases of what we think would happen if so and so wins versus the other person. And yeah, we'll just keep a very open mind. Sorry about that. What were you
Yeah.
saying?
Well, and to that point, we just saw that with the Mexican elections. Everyone kind of knew who the president elect was going to be, but um, it was kind of a surprise how Congress went so far one way, and that made a big difference. Okay, look, you know, politics aside, what the market likes is gridlock.
Yeah.
So it doesn't matter who you have in office
Yeah.
on the executive side, as long as you have the opposite on the legislative side, that's what the market prefers the most. So,
Yeah, that's funny. I remember our old wall charts that we had, and up on
mhm,
top it would have, who was in the Senate and in Congress, and who was what team,
yeah,
red or blue, was in the White House, and talking to Bill about it. And I had never studied it, and he really was saying how big of a deal that was, even as much as he was very political, that he wanted things to be divided from a market standpoint, because the gridlock, as you said, like then people can put in their spreadsheets what they think is going to happen when you have one side, whichever side, um, controlling everything. Then you really don't know how far they're going to push things. So yeah, gridlock I would have to say, based on history, would be our best for the market.
yeah. So a few other headlines. I know that we've probably got some folks that are affected by the hurricanes, and we wish you the best. Stay safe out there. But we were talking about port strike, and on the East Coast, what that could do, and to the economy and moving goods around, and now we've got this double whammy between Helene and Milton on the hurricane side. So that's something that we're watching, and we certainly saw some effects on the insurance side yesterday. Middle East tensions. Look, this was just the year yesterday from the Hamas Israel situation in the Middle East, and so We are seeing some of that effect on oil. Some of the oil stocks have been, showing some volatility as it's like, okay, what's going to happen here in terms of supply? Is there going to be an attack, retaliatory attack on Iran? So a lot of question marks there. On the economic side, I mean, for a while there, it seemed like we weren't doing anything because it was like, oh, we've got the CPI report or the PCE report or the jobs report. And I feel like this last time, the PCE report, I don't remember us talking like, oh, we can't do that because the PCE report is tomorrow. We've got the CPI report coming on Thursday, and that didn't really slow us down at all, today. But we should probably talk about the jobs report last week because that was something that did shift things pretty considerably.
It did, and I will say, and you can pull up. I think you have the Fed funds futures before and after that,
Mm-hmm.
but now that Powell has did such a great job at his last press conference, I think whatever news we get, hot, cold, or as expected for CPI, PCE going forward, that the market might have a knee-jerk reaction, but then it's just going to go back to its natural trend that right now is up to sideways, because we all have confidence in Powell, or at least a lot of us do that didn't before. And so I think, he'll deal with the numbers. Before, it was a big risk event because he was in my opinion, on a predetermined path of what he was going to do, and it wasn't going to budge based off of the numbers. He said he was data dependent, but he wasn't acting that way. Now he
Up. I think he might have frozen again. So I'm just going to kind of go through real quick and talk a little bit about this chart. This is something that Chris and I went over last week, and what we saw was a very big shift. I mean, Chris and I were talking last week about the shift because we had noted how we were at over 2/3 chance that we were going to have a 50 basis point cut. And when we showed this last week on Tuesday, we were down to a 37% chance for a 50 basis point cut, and a 62% chance for a 25 basis point cut, 0% chance of staying the same. It was basically 100% chance that there was going to be a cut. Now let's fast forward to after the jobs report, how different that looks. And I again, this looks so different. I had to just kind of note where the bar was, that that 25 basis point cut, because you can see that now we're looking at a very different situation. We're looking at and I'm struggling to read it a little bit. Let me see. Is
I'm
that
trying to
86?
not
Yeah,
touch my computer. So
86.7% chance for a 25 basis point cut. And instead of a 0% chance of a hike, and instead of a 0% chance of staying the same, it's now a 13% chance of staying the same and a 0% chance of a 50 basis point. So this jobs report really did shift things pretty dramatically. And we saw the 10-year treasury yield go up significantly as a result. And that really kind of changed how some of the groups were acting. And it looks like you're back, Mike.
yeah, I'm back. I'm not going to touch my computer because anytime I do,
It doesn't
it
like it.
it doesn't like it. So yeah, let's go back to the S&P if you don't mind.
Okay.
And then with all these changes to what's happening with the Fed funds futures, and I know everyone likes to look at the bond market, so let's go ahead and pull up like the 0 TNX or whatever you
Yeah, so this is the
prefer.
10-year treasury yield. So it's going to go opposite the bond prices. This is what the yield is, and you can see that we definitely got a big move on Friday on that jobs report, and I mean, we were already kind of heading in that direction considerably, and so now we're back over 4% on the 10-year treasury yield.
Yeah, and so the reason why I wanted to bring this one up is because lots of movement over the last week there, but now let's go back to SPY. And this is something I always say on IBD Live is, I I've talked to Bill about the market. I don't know how many hundreds or thousands of hours, and he never once brought up the bond market.
Mhm.
It was just not something that he was concerned with, even though he understood clearly how important it was for the economy, for mortgages, for any type of loans, and it's very important. But the concept was keep it simple. Just look at the index that you're trading or the stocks you're trading and see that reaction. So if you can contrast what was going on in the bond market over the last week versus the stock market, it's been like a non-event here, but lots of volatility there. And so I think that's again going at the point that the stock market is now comfortable that the Fed is going to work itself out. Maybe we won't have that hard landing that we've all been worried about, and so that if employment is a bit stronger, then they just go slower. But that in the end, that's a good thing, you
Yeah.
know. But so, anyways, the point is, I would just say keep things simple and just look at, because it's hard enough as it is. Just look at the major indices, the SPY, the New York Composite, the Nasdaq, and then I think we could probably wrap things up with, because I'm afraid of my computer going out, maybe with the XHB and just toggle over to that.
Mhm.
So this is one that we were very bullish on, because it just made sense with the interest rate environment, shifting from where it was to where it's headed and where it's started to go. That this would lift, but with that volatility that we saw, with the changes at the speed of the cuts, this fell off quite a bit, but it firmed up right at its 21 day. So it's telling you that what the market is pricing this in. We had a little mini upside reversal yesterday, so it shook out the day before, gave you that expectation of moving higher today, and that's what it did. So this is certainly wasn't the strongest place in the market right today, but it's looking set up. So that means we don't have another group that's falling off a cliff, which is just another reason to say to be bullish, but also to be aware of the wiggles and wobbles. And as that was fading, you had to back away from those positions. But now I think it's safe to nibble back in that space. And we started today with a baby position in one stock in that space. And if it works, we'll add more. And if it doesn't, we'll just back away. So just be nimble. And it is a market that you have to be nimble in.
Mhm. Let's also go ahead and just end with the pie graphs that we show each week to kind of show where we've shifted our exposure. So last week, October 1st, we did have quite a bit of cash, and we were spread out into energy, building, finance, aerospace, consumer, and we're probably even more spread out now. Instead of the ETF, being a 23% position, we've brought that down to 15%. We've got chips exposure, we've got computer exposure, software exposure. So we're not completely ignoring tech, but we still have consumer, energy, real estate, finance. It's quite spread out. So
And
any
that's
any
on
kind of thoughts
purpose.
on this?
Yeah, and that's on purpose because of what we've been talking about, the whipsaws that you're getting in sectors that we, at this point, we just don't want to make any heavy bets in one area. So we're spreading it out. And we're doing less ETFs at the moment just because frankly there's so many stocks to be bought. We had, you know, another 4 or 5 names that we could have added to the list today. We try to cap it at, our goal is to not put more than 2 or 3 new names on in any given day. I think we did 4 today. So, we were pushing it there, but we also didn't have the cash because we don't want to go on margin until we really start, connecting. And when we do, then we'll go out on margin, or, we might go 5% on margin, but by margin, I mean, 15, 20%, something like that. And so being spread out makes sense when there's a lot of things to be bought, and there are a ton of names out there.
Mhm. So I wanted to just real quickly take a few questions from our YouTube audience that's watching live. We really appreciate you guys tuning in. One of the things that came up, and we can switch back over to market surge if you don't mind, Dominic, who is helping out in the back. One of the things that came up was the ATR. Where to find that? It's a column that you can add in Market Surge, and a lot of folks were saying, hey, is this because the way that you do it is on Market Surge, you're going to get it in price terms. So what I do is I export it to Excel, and then I'll do a quick calculation. You take the price divided by the current price. I'm the ATR divided by the current price, and that gives you a percentage. And so that's how I do it myself. And those are those numbers that I was quoting to everyone. So I do that in Excel. Some folks were asking, well, is that something can you do the math for us and put that in Market Surge? We are working on that. And Mike is working on a special new, what would you call it? An ATR rating?
Yeah, an ATR rating. It'll be 1 to 99 because we like to keep things simple. That's something that, Bill, pounded in, in our heads to keep things as simple as possible, not any simpler. So we'll do a 1 to 99 ATR rating. That way you can know if you're searching for heat, you can search for the ones that have a very low ATR rating, 1 to 10 or 1 to 20. And if you're wanting something slower and pokier, then you're going to go with something, an 80 or higher. And so you'll be able to screen it for it. Eventually, we'll put it in on the chart. And of course, we'll also do it from a percent standpoint as well. So you can screen if you just want, hey, I want ATRs that are less than 3%, then we're going to put that in there. But I think the ATR rating is going to be the easy way for most people to look at things. And I can't wait. We're almost done with it. We just have a little quality control to do, and then we'll get it rolled out as quickly as we can.
Yeah. And then also one other question that came up from YouTube. Some folks asking about the dollar, the strength in the dollar. This certainly it's a variable that, especially like with commodities and a lot of things, but is this something that you really track that much, Mike?
Never. And it goes back to the same thing, that the dollar is very important. The currency market is huge and very important. Bond market is massive and very important. But it goes back to Bill's philosophy that he taught us, that just keep it as simple as possible. Just look at the stock market if you're trading the stock market. Now, if you're trading currencies or you're trading instruments that the currencies have a huge impact on, commodities and such, then focus more on that and look at the trend of what it's doing. But no, I think it just adds confusion. And I know I like to look at a lot of indicators and things, but they're all based really off of the price action. It's just slicing the price action in different ways. So it looks like it's more complex than it really is. So keep things as simple as possible. Just look at the price in relation. If anything, just look at the price in relationship to the 21-day exponential, and that'll keep you on track.
Very good. That's going to wrap it up for us this week. We're going to let Mike go and let his computer think about what it's done. But again, we appreciate everyone joining us for this. We will see you all next week. Take care, everybody.